Hi, I'm Tim Kelley from the Montgomery Fund and welcome to this week's Video Insight. Australian investors are big fans of dividends, and with interest rates shrinking to record low levels, it's easy to understand why investors might prefer dividends to interest. And when franking credits are taken into account, the yield on offer from some of Australia's largest corporates looks like a no-brainer. If a business like Telstra can deliver a gross yield of close to 6.5%, and there's no reason to think its earnings are at risk of decline, why on earth would anyone in their right mind choose to leave money in cash, earning less than half that? Well, we would for one. Let me explain why. When you earn a share for a period of time, the return you earn has two components, the dividend yield and the capital gain. Over long periods of time, the dividend yield, excluding franking credits, tends to average somewhere near 4.5%, and the capital gain tends to be around 6% for a total return of around 10.5%. Telstra is currently in line with these long-term averages for yield, but what about growth? A typical industrial company can achieve growth by retaining some of its profits each year and reinvesting them in expanding the firm's asset base. This means a lower dividend than could have been paid, but shareholders can expect to be compensated for that with higher earnings in the future. Telstra is a little different. It tends to pay out pretty much all of its earnings as dividends and retains very little to reinvest in growth. This is not necessarily a bad thing. It may be that, given Telstra's size, it has few opportunities left to reinvest, but it does mean two things. Firstly, Telstra's dividend is higher than it would be if the company were reinvesting for growth, and secondly, Telstra doesn't really grow. While it has delivered some improvements in operating performance in recent periods, over longer timeframes, the growth story is weak. Indeed, current earnings are not far from where they were a decade ago. Looking in the rearview mirror, Telstra shares have gone from below $3 in 2011 to more than $6.50 recently. Clearly, investors have enjoyed bucket loads of capital growth, making Telstra shares a spectacular investment, and it's true. Telstra shares have soared in recent years and investors have done extremely well. However, when share prices rise strongly in the absence of corresponding earnings growth, it usually means one of two things. Either the shares were too cheap to begin with and the market has merely adjusted them to the correct level, or they were not too cheap to begin with and the market has now pushed the price well above intrinsic value. In the case of Telstra, it looks to us very much like the latter. More specifically, it looks like yield-hungry investors might have bought Telstra for its dividend in recent years and turned a blind eye to the question of underlying value. That dynamic may continue for some time to come, but in the long run, share prices tend to find their way back towards intrinsic value. If and when that happens, the fully franked dividend yield currently on offer might not provide much comfort. That's all for this week. We'll be back with more next week, and in the meantime, don't forget to follow us on Facebook and Twitter.